January 30th, 2000. The Super Bowl is on. In between touchdowns and tackles, a sock puppet appears. It's a simple, charming pitchman with a microphone, singing a catchy tune about not wanting to leave the house. This is Pets.com, and it just bought its way into 80 million living rooms. The puppet is an overnight sensation. The company feels inevitable. 10 days later, it's a publicly traded stock. Fast forward to November 6th of the same year. An internal memo announces the company is liquidating. The website will go dark. Most of the 320 employees are being laid off. Effective immediately. 9 months. From a Super Bowl debut to a corporate obituary. That's not a business stumble. That's the story of a rocket that flew straight into a wall. This is the peak, the cracks, the unraveling, and the lesson of the most famous flameout of the dot-com bubble. To understand Pets.com, you have to understand the weather in late 1999. The NASDAQ was a rocket, and the fuel was a simple idea. Get big fast. Profits were a problem for tomorrow. Today was about one thing. Eyeballs. How many people saw your logo? How many clicked your banner ad? In this environment, spending more than you made wasn't just acceptable. It was a badge of honor. It meant you were growing. The idea for Pets.com seemed like a perfect fit for the era. Americans loved their pets and spent billions on them. The pitch was frictionless. Why wrestle a 40-pound bag of kibble from a big box store when a website could drop it on your doorstep, often for less money? It felt like the future, delivered in a cardboard box. And at the center of it all was the puppet. It wasn't just a mascot. It was a media phenomenon, developed by the same creative agency that gave the world the Taco Bell Chihuahua. The Pets.com sock puppet had genuine star power. It appeared on Good Morning America. It had a giant balloon in the Macy's Thanksgiving Day parade. People who didn't own a pet knew the puppet. This was the get big fast philosophy executed to perfection. The brand awareness was off the charts. For a moment, it seemed like you could build a massive, permanent company out of sheer visibility. The puppet was funny, relatable, and completely disconnected from the messy logistics of what the company actually did. Then came the ultimate validation. On February 9th, 2000, Pets.com went public on the NASDAQ under the ticker IPET. Led by CEO Julie Wainwright, the company sold 7.5 million shares at $11 each, raising about $82.5 million before fees. And they had a kingmaker in their corner. Amazon.com. Jeff Bezos's retail giant had invested early and, after the IPO, held a stake widely reported to be around 30%. This wasn't just capital, it was a halo. If the company that was redefining commerce believed in Pets.com, who were you to argue? It looked like a permanent fixture on the new digital landscape. The revenue numbers were climbing, customers were signing up, and the puppet was a celebrity. From the outside, the foundation looked like solid rock, but the foundation was actually sand. The quiet crack in the Pets.com model wasn't in its marketing or its brand. It was in its physics. The company was trying to sell heavy, bulky, low-margin products through a system built for shipping light, high-margin goods like books and CDs. The core of their business wasn't a weightless digital file. It was a 40-pound bag of dog food. Let's walk through the math of a single order. A customer buys that 40-pound bag on sale for, say, $25. At the time, commodity pet food carried a razor-thin gross margin for retailers, often in the single digits. Let's be generous and say Pets.com made $3 on the product itself. Now, we ship it. In the year 2000, without the sophisticated logistics networks we have today, shipping that heavy, awkward bag across the country could easily cost $10, $15, even $20. Add in the cost of the box and the labor to pack it. Suddenly, that $3 profit is a $10 loss. And we haven't even paid to get the customer yet. Pets.com was offering aggressive first-time buyer discounts and free shipping on orders over a certain amount. A customer could easily place an order where the company lost money on the product, lost more money on the shipping, and then paid even more for the banner ad that brought the customer to the site in the first place. This wasn't a business model, it was a customer subsidy machine. And they were paying a fortune to acquire those money-losing customers. In the first quarter of 2000, the same quarter as their Super Bowl triumph and their IPO, the company's filings revealed it spent about $11.8 million on advertising. Its revenue for that same period? About $5.8 million. They were spending $2 on marketing for every $1 of sales that came in the door. The business wasn't scaling toward profitability. It was scaling toward a bigger, faster bonfire of cash. The more pet food they sold, the more money they lost. The celebrity puppet wasn't selling a product. It was the world's most charming pitchman for burning venture capital. A business model this broken can only survive as long as the market is willing to look the other way and keep funding the losses. On March 10, 2000, exactly 1 month after the Pets.com IPO, the market stopped looking the other way. The Nasdaq Composite Index peaked, and then it began to fall. And fall. And fall. The dot-com bubble had burst. Suddenly, eyeballs wasn't the metric that mattered anymore. Investors wanted to see a path to profit. They wanted to know about unit economics and gross margins. The very questions that Pets.com couldn't answer. The fire hose of easy capital that had fueled the entire get big fast era was turned off almost overnight. To their credit, the team at Pets.com knew their model was broken. They were making rational moves to fix it. They just ran out of time. In mid-2000, they opened a massive, state-of-the-art warehouse in Greenwood, Indiana. The logic was sound. A central distribution point would cut down shipping zones and costs. It was the right move. In a normal world, it might have worked. But this wasn't a normal world. This was a world where their $82 million IPO purse was draining away at a terrifying rate. Building warehouses and optimizing logistics costs money, and, more importantly, it takes time to show results. Time was the one thing they no longer had. They made another desperate, logical bet. In the summer of 2000, they acquired one of their main rivals, Petstore.com. The thinking here was also clear: consolidation. If they could absorb a competitor, they would gain more customers, more order volume, and therefore more leverage with suppliers and shippers to bring down costs. They folded Petstore.com's customers into their system, hoping the added scale would be enough to bend the cost curve before the money was gone. But it was like trying to fill a leaky bucket by adding more water. The fundamental problem remained. Each new customer, each new order, just accelerated the burn. The spreadsheet was unforgiving. By the fall, the numbers were brutal. For the 9 months ending on September 30, 2000, the company had generated about $22 million in revenue. Its net loss for that same period was a staggering $147 million. They had lost nearly $7 for every dollar of product they sold. The Amazon backing couldn't save them. The celebrity puppet couldn't save them. The smart, late-game operational fixes couldn't save them. The clock had run out. On November 6th, the board made the only decision left. They would shut it down, try to sell the assets, and return what little cash remained to shareholders. 255 people were told their jobs were gone, just weeks before the holidays. So what is the lesson of Pets.com? It's that awareness is not a business model. You can buy attention. You can build a beloved brand. You can become a cultural touchstone. But if the basic math of your business doesn't work, you're just building a more famous failure. The story beats the spreadsheet only for a little while. Eventually, the spreadsheet always wins. The demand for online pet supplies was real. The service was, by most accounts, pretty good. But they were selling dollar bills for 85 cents and trying to make it up in volume. Gravity always reasserts itself. The other lesson is about timing. Was the core idea of Pets.com wrong? No. A company called Chewy would come along a decade later and build a multi-billion-dollar business on almost the exact same premise. But Chewy had the advantage of 10 years of innovation. Cheaper internet infrastructure, smarter logistics software, a vast network of automated fulfillment centers, and customers who were far more comfortable with e-commerce. Pets.com had the right idea in the wrong decade. Their smart moves, like the Indiana warehouse, were just a decade too early and $100 million too short. In business, being too early is often indistinguishable from being wrong. The final irony is what happened next. The assets were sold for parts. In 2001, rival PetSmart bought the Pets.com domain name for a reported $3.35 million. The most valuable asset, the sock puppet character itself, was sold at a bankruptcy auction. It fetched about $125,000. The buyer? A company called 1-800-BAR-NONE, which sold car loans. Soon enough, the puppet was back on television, hawking used cars. The brand was so strong, it outlived the company that created it. The business became a cautionary tale, the punchline for an entire era of irrational exuberance. But the puppet was a survivor.